Good morning, everybody. Welcome to the Hurley Investments Trade Findings and Adjustments of April 7th. It's a really wonderful, pretty spring day here in Utah. It's good to have you guys with me. Looks like a couple people still joining here. So I'll wait just a couple more seconds. For those of you here, can you hear me loud and clear? Thanks, James. Perfect. All right, guys, let's get started. So just as I like to do, a little bit of a recap from last time. Went over just our current situation, kind of just thought through all the things that we are dealing with and having to worry about. And what we would do for a possible some trade ideas and what we need to be hesitant of, concerned about as we look to do some investing. So what we came up with was we now have interest rates going higher, some more reiterating of that fact has gone on in the last couple weeks, specifically yesterday. Fed Brainerd, I think, had reiterated the fact that the balance sheet, which is all those bonds and securities that the Fed holds, is going to have to come down quite dramatically, which means they're selling a lot of those assets to tighten up money, and interest rate hikes again might have to come up 50 basis points as opposed to a quarter of a percent. Still have issues with Russia and Ukraine, still have high gas prices, although tapered off slightly. We talked about other commodities. We have supply chain issues, which in my opinion should be a positive thing as far as what could be more or less resolved in the coming year, as it's part of the whole reopening of the economy. So the world is still getting back to getting on its feet again after COVID, and so the supply chain issues are just a little bit of that coming back to play. So I kind of more see this as somewhat of a positive thing, as it's even though we have supply chain issues, that it's something I feel is going to continue to pan out and flesh itself out over the course of the year, which will be good for companies, especially our retail, and really for everything. Tax season, we talked about that there could be some tax selling, and certainly if you look at the chart here, that could be part of what we're dealing with. As you know, not much has changed since we had this huge rally in our market, coming up from 4,200 all the way to 4,650 almost 46.50, probably like 46, and really on nothing. The Ukraine war had a bit of a pause for a bit, not really. We're really still dealing with all these issues, and I think that they're simply a realization by the market that um, after this day, mid-March, once we found out from the Fed that they're indeed raising rates as expected and did a rate hike, it was kind of okay, now we got over that, what we already knew was going to happen, and it's kind of, what we expected, and the market went back up a bit. But I think it's that realization that we're still not out of the woods. And market typically gets ahead of itself, right? And I think we're still dealing with those issues now. So, all right. Let's see. We talked about some stocks that we could look at for leap options. Went over leap call options. Discussed Apple, Facebook, Disney, all of which are down since then. But as I mentioned, there we go. That was back end of March. As I mentioned somewhere around here in the last webinar, that as stocks had come back so quickly, it made sense to be cautious getting into bullish trades, and it made sense to be patient for possibly a dip that you could buy some of these stocks. Apple, that's more for the reasoning on Apple, as it had already gotten back up to that almost 180-ish, 177.50 price range. So for the story of Apple, it's really where on a valuation metric could they get up to, and they still haven't gotten to. And if you were here Monday to listen to Kevin, he went over some of our core positions once again, and where our stocks such as an Apple could get to, and it was higher into the 200s. So a trade right now or on a dip would be looking for an Apple to get up to 200 or more. I think it was closer to 219, somewhere around there. But I also suggested some other thoughts for a Facebook, which is already well off its highs, and certainly a huge opportunity there. Hitting this 50-day and struggling to stay over it. So again, just because of the last 2 weeks and the trend that we're headed right now, I would certainly be looking to find a place where things settle down at. The market is dragging everything back down, and we definitely want to be conscious of where the market's going and the trend that it's taking, because we have this news-driven market that just looking at a technical on your stock charts isn't going to give you the full story on why things are moving around. So you got to keep paying attention to what the S&P is doing. And right now we're trending down. We're falling below a 50-day, excuse me, a 200-day. We've got the 50-day next that we'll probably test. We have this crossover of the 50-day below the 200-day, which is we call our death cross affectionately. And the 50 under 200-day typically signifies 10% correction, which as you can see, we never really got. It came down prior to that, but obviously if the 50 is going to cross below the 200-day, obviously preceding that point is going to be a trend down to make that happen. So typically after that, we would see that 10% correction, 5%, something around. I think it's actually technically an 8%, and we never really saw that. So that's something to be concerned about and well, not necessarily be concerned about, but keep an eye on. So I guess my point is we still have all of these issues, and I feel as though we need to be a bit more cautious, putting on bullish trades and being patient to find a place where the market is settling down, possibly back down here at that 42 level, 4,200, before we're looking at placing a bullish trade. So I'm just gonna look at Facebook. Already down, of course. This one doesn't have to move too much to have a good excuse to buy, although 225 down to 190, that's quite a bit, but looking at the chart is a bit deceiving. And we also talked about Disney. Already back down here at 130. This might be something to keep an eye on to confirm a bounce. It's got to be somewhere around here. It's 1-2 times that it's hit this one just below, well, let's see, just below 130. That might give us a good opportunity to buy a Disney leap call. So one thing that I wanted to show you guys, kind of go along with this idea of trading leap call options. We talk about it as our stock replacement, simply because if you go out about a year, which is a leap call option, it gives you about 10% of the risk of owning 100 shares of stock for every one contract of calls. So it's a stock replacement and considered a hedge to stock ownership because it's only 10% of the risk of actually owning 100 shares of stock. So it costs 90% less. You still get to be a part of the stock movement. Talked about how we the rule of thumb is to dollar cost average 3 times at most, so that we're not throwing good money at bad. You can keep dollar cost averaging until you're blue in the face and buying, and just not see that stock come back in the time that you need it to. So you just need to be careful about that and keep that in mind. So limit yourself to about 3 times, which means you got to have cash setting aside to be able to make that happen. We kind of went over that more last time, so I'll leave that alone. You can go back to my Hurley investment I want to say it was April 24th. Let me find out. When was my last webinar? Yes, not April 24th, but March 24th. So go to Hurley, My Hurley Investment, and look at the March 24th trade findings, where I go over all of this stuff. So let me get rid of some of this. Right now, we're looking for a good time also to buy a Boeing leap calls. We've already had some, and on this drop a couple weeks ago, where was it? It might have been even back here. We got rid of a bunch of Boeing leap call options because it just wasn't so it was so far out of the money. They were up here at 250, I believe, 300, 330s, that even though we could have dollar cost averaged, it's just so far out of the money, meaning the difference between where it's currently trading and where our strike price is on those options, that we're just looking for an opportunity to buy new ones further out in time, closer to where it's trading. So maybe a 200 leap call option instead of having them clear up at 300. Gives us a little bit better opportunity to be profitable as whenever Boeing decides to start heading back up. They have now been delivering planes to China, their new 737 Maxes, which is a nice sign. It's China isn't a huge part of their market, but it certainly could be. So that's something we are keeping our eyes on. And speaking of leap calls, here's one we just closed this morning. So we had Costco. Let me bring up a Costco. Costco last year was, I think, our biggest return overall, not just percentage, but biggest return. And all we did was leap call options. Leap call options on Costco. Let me bring up a call, or excuse me, a chart. This is out to a year, if it will update. Here we go. So 2021, Costco had a blip kind of March-ish area where we had bought call options and it pretty much didn't do much else but go up at let's see, somewhere around here, around 500, they had their earnings, and we had taken a profit on I think 500 and 550 leap calls, which we had bought, when it was back down here. So we had a ridiculous profit that we took those off and rolled them up to 600 strike leap calls, which looked nice into the end of the year, and in the beginning of this year just looked pretty crappy until today. They finally got up to 600. And so to show you my cost basis for 2 contracts, we had these for several accounts, about I think 46 of them. So this is just an account of mine, but started at 4,100 for 2 contracts, so they cost about $2,000 each. And for 182% return, Sold those for 11,500. So not too bad. Not bad at all. And Kevin and I discussed this morning, well, what if we rolled those ones up? Do we take a profit now? Maybe we buy 650 leap calls. And this certainly a good possibility and a good thought. But I kind of feel as though because of this situation that we're in with the market, even though Costco's done a good job lately of breaking the market trend, I just feel we're going to get an opportunity at some point to buy these leap calls back on a dip. Would be smart if we get a dip, but that's certainly not always what happens. I mean, you can see again, there really wasn't much of a dip since March of 2021 all year. If you were looking for a good dip, I mean, there was a couple of them, but really it was just going up so much. Costco had come out with same-store sales that beat expectations. So that's why they're up yesterday and today so significantly. So that's the conversation that me and Kevin are having right now. We just like to argue about stuff and come up with a good game plan. And usually one of us plays devil's advocate, and we come up with I think usually a better decision than we would have if it was just one or the other of us. So that is another one, Boeing and Costco, that we're looking at, sprinkling some leap calls in again for. Guys, I've pretty much been talking the whole time and haven't asked a lot of questions. I apologize for that. I just kind of wanted to go over those things. Are there any thoughts or questions? Because of our recent trend down these last couple days, since Monday, we had an amazing up day on Monday, and then Tuesday, Wednesday, and today really have been crappy days. So Tuesday and Wednesday, we started to get protection back on as things started to turn. So here, got Apple protection back on. Bank of America had already been coming down. We might find a good opportunity to take protection back off, because for heaven's sakes, banks with higher interest rates should be going up. Boeing, again, broken a pivot point without much of a thought. Broken a shorter term kind of trend here. Got protection back on that, which was wonderful. In fact, we might have actually caught this day, if I remember right. Baidu, just not holding on 140 and can't get above this 50 days. Tried 3, 4, 5 times now. 1, 2, 3, 4, 5, 6. Disney, showed you this, can't get above the 50-day, trend back down. Ford, not only could it not get above the 50-day, it once again broke the 200-day. Facebook, got above the 50-day for 1-2 days and then fell below it yesterday and today. Let's see, what else do we got? Oh, I already showed you Costco is going up, so don't need to show that one. Under Armour, 2 days above the 50-day, came back down. Visa was looking good back here to recent highs. And then, of course, the last few days back below the 200, back below the 50-day. And we'd already had covered calls as our situation on stock with a short call above it at 230 to get a nice $5-6 of credit. So that's helped us a bit on the way down. And we'll need to get that protected today with not being able to stay above the 50-day now. So I'll admit it was nice Monday to see how just to have that 3% up day, but how quickly things reverse is pretty amazing. And all I'm gonna say, just gonna type a quick description here on this trade. If there's any other questions, thoughts, anything you guys would like me to look at, go ahead and type it in. We've got a question. Netflix. Look at Netflix. Netflix is not one of our stocks that we hold because we like Disney more, but let's take a look at it. Got as low as 332. Man, tried for a whole week to get above a 50-day and just kept touching it and coming down. Was up above it one day, came down below it and finished below it, and that's where we're headed now. So again, I think all of this is just a realization that after the market coming up so swiftly from the rate hike that it was just ahead of itself once again. And that the current risks are not off the table. But Netflix, just to give you my thoughts, Destin, certainly one that's well off of its highs. Man, they've lost over almost half their value. Yeah, just almost exactly half, right? 350 from 700. So certainly an opportunity as far as maybe a dip buyer, but so is Disney. And to compare the two, just this last earnings quarter, we found out that Disney took a lot of subscribers away from Netflix, biggest competitor now. Disney also, aside from the streaming, has their parks reopening. And man, if you haven't seen a Disney commercial for their parks lately, you must be living in a hole in the ground, because they are pumping them out, trying to get people back in the parks, and they are getting packed again. We went back in February with my little family, and that was even before they got rid of the masks indoors, like a week after we went. And it was still quite as busy as I have ever seen it. They've got their cruise lines coming back soon. I think there's more from a Disney. They've got a more diversified portfolio of investments in their business. And just going back to Disney, Disney is well off their highs too. They were up, let's look at a longer chart. They were up above 200 not too long ago. So 200 almost exactly. And then went sideways all last year and then just fell all the way down to 130. So 130 has been a stopping place before a couple times. But you know, if it's something you wanted to try on both of them, you certainly could do that, and I'd look at leaps for either of them, because I don't think Netflix necessarily deserves losing half their value either. But they have also in the past, for many years, just bought back their stock shares to drive up their stock price. So I do feel like they did get ahead of themselves, tech stock style. So I hope that gives you some stuff to think about, Destin. And again, if you're looking at doing a leap such as this, go back to March 24th, go to this here, myhurleyinvestmentsingular.com, and it's where we post all of these videos right now that we're making. So you have them all in one place, and you just look at the date and you're good to go. So check that out. And then just wanted to do 11,585 divided by 200. We sold them for almost 58. I'll just say 57. So you can see for 182% return, sounds amazing, but you can see how easy it could be for someone to look at that and then stupidly put way too much money into a trade like this. I did 4,000, and it's just something you gotta be reasonable with yourself and honest with yourself. Spent 4,000. I was prepared to dollar cost average again. If it lost half of its value and dropped to 2,000, I was prepared to buy another one. If it lost half of its value down to 1,000, once again, I was prepared to buy another one, all the way to 3 times. So that would have been 2, I guess, so to 500, I'd bought a third one. Doubled down, I should say, a third time, dollar cost average. And so I had to have obviously more in my account, double this, at least for just this one trade, in case I had to do that. But as luck would have it, this one was not one of those ones. And even though it was kind of whipping around at some occasions, this looked so good. When this morning when I saw Costco hit 600, And that was my point that I decided before. I'm happy to take a profit. So pretty cool. Guys, if there's no other questions, thank you so much for joining me this morning. Hopefully you have a good weekend, and join me again as we listen to Kevin on Monday. It was really nice. If you missed last Monday's webinar, I'd encourage you to go back. My Hurley investment was on the 4th. This one here, Kevin went over pretty much all of our stock positions just to kind of show how we valued them. We did this like at the beginning of the year where we showed all of the stocks that we hold and how we just went through the math on where we expected the stock to be based on a value, a Warren Buffett style valuation method. And so he basically just did that again, looking at our forward PE and earning EPS and where we expected the stock to be. And so that is a good one to see and to go over again. So I encourage you to do that if you weren't there Monday. Besides that, that does it for me. Thank you guys so much for joining me this morning, and we will see you next time. Take care. Thanks, James. Thanks, Ida. See you guys next time. Bye.